Yes. All right. Advisors of Earth, how are you? My name is Michael Batnick, and on today's Talking Wealth, I am joined by Ian Wenik. Ian is the editor of Citywire RIA. He is one of the sharpest reporters covering the RIA landscape. He gives us a front row seat to the M&A frenzy, private equity land grabs, and behind-the-scenes drama that rarely makes it into the press releases, from the tips that hit his inbox to the power struggles helping shape the future of wealth management. Ian shares how the headlines really get made, what advisors often get wrong about the media, and why some firms go to great lengths to keep things quiet. If you want the unfiltered story behind this story, did I double story? I did. This episode delivers. But first, a word from our sponsors. Today's show is brought to you by our sponsors at Betterment Advisor Solutions. If you happen to be thinking there's got to be a better way to grow my RIA, you are not alone. With Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most to your clients, from improved service that makes asset transition smoother to fast, paper-free onboarding that delights clients on day one. We've built a digital-first platform designed to streamline your operations and make life easier. So now if you're thinking, wow, they take the paper out of paperwork, you'd be right. So grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk, performance not guaranteed. All right, Ian, welcome. Thanks for doing this.
No, thank you so much for having me. I'm really excited to be here today.
You know, I kind of feel like the gazelle interviewing the cheetah, or maybe even the lion. Usually I'm deathly running away from you, but now the shoe is on the other foot, so I'm excited to have you on the other side of the mic. All right, so let's start here. How did this happen to you? Like, how did you become the preeminent reporter covering my industry?
So first off, you use a lot of adjectives that I would not use to describe myself. Feared, respected, preeminent.
You're like the Godfather.
I don't have any. There are no rings on here. Well, there's my wedding ring, but there's no other rings in here for people to kiss. But to get to your question directly, I entered this industry, I think, like a lot of people in this space did, pretty much entirely by accident. So growing up, when I was going through high school, when I was going through college, when I was doing my master's, all that I wanted to do was write about sports. Like, my dream was that I could be, I don't know if you ever read Sports Illustrated growing up, like Paul Zimmerman, Dr. Z. I wanted to be like the next Dr. Z writing about the Giants. That was going to be me. I wanted to be the next Dr. Z. And I realized I was doing my master's just how I did a lot of internships in the sports space at Newsday too. And I just realized how awful the job market was when I was doing my master's. And I graduated from Columbia J School in 2016. I did not have a full-time job. I was simultaneously interning for a business trade publication that covered M&A and bankruptcy called The Deal, while interviewing for a production research job at ESPN. And what happened was ESPN brought me up to Bristol for a couple days while I was doing, it's like an investment banking super day, while I was covering some pretty big bankruptcies, Golfsmith, Sports Authority, Aeropostale. And I thought I had the ESPN job. It didn't work out. And I said, okay, I'm going to go all in on business. I covered bankruptcy for about a year. Then I hopped to covering distressed debt. And I ended up at Citywire in 2018.
Okay. All right. I had no idea that you were a Giants guy.
Yeah, big time. I mean, I've got season tickets, section 225B, if you ever want to come say hi.
Okay. I go to one game a year. That's all I could take. All right. So I was going to start out with this question. Like, this is a relatively boring industry. It's nothing like sports. It's nothing like Hollywood. There is not a lot of turf wars or salacious headlines. For the most part, everybody gets along. And I was going to ask you, like, how do you even bring the stories to life? But then I said, hey, wait a minute. I was thinking about this more, covering the industry. And even though it is a relatively boring industry by the other standards that I set, there is a lot to cover. So just a few of the things that you do on the day-to-day. There are asset managers, and then underneath them is like a billion subcategories, right? You've got RIAs, which is your beat. And then within them, you have the C-suite executives. You've got private equity-backed roll-ups, the custodians, wealth tech, and the investors backing them, conferences, M&A, end clients, wirehouses, and I'm sure there are many things that I missed, everything in between. So how do you, at Citywire, how do you like segment it? How do you know what's your beat, what's on somebody else's lawn?
So let's back up first, because I think that using boring to describe this industry, one, I think that's a relative term. I think this industry has gotten exponentially more exciting. And I think that I'm fortunate that I started covering this space in 2018.
That's true.
Which I think was the year, I think it is kind of a seminal year, that this industry turned from everybody being kind of kumbaya, we're all friends with each other, let's build this channel together, to actually being an industry with elbows getting sharper, more mature, professionalized businesses. So let's go over some of the things that happened in 2018 that, not salacious, but certainly interesting. We had the Edelman Financial Services, Edelman Financial Engines deal, which was a $3.02 billion valuation print, which was a pretty big number at the time. We had the power struggle between Mark Hurley and Howard Milstein for control of Fiduciary Network, which led to his eventual ouster. And then we had a lot of the transitions we had at Hightower, which started in 2017 and went to 2018. So, those were three major headline-getting stories that just showed the changes of these businesses. I think the Hightower thing is especially fascinating, because what we've seen is that a lot of these businesses have gone from being personality-driven businesses, the ones that have been built by the Rick Edelmans, the Amani Carsons of the world, into institutionally driven businesses. And that was the start of this. And everything we've seen then, all these mega mergers that we've been able to break, all this drama, all the battle for control, the executive changes, it's all downstream from this maturing. And then to get to what you most directly asked, which is how we kind of segment stuff. So I think it helps that we have our sister publication, Professional Buyer, which covers the asset management and manager research industry. So my team and I, we can really just go all in on covering RIAs as a whole. So we can I think that it's less covering specific channels versus specific themes. So for example, I have, I think, a reputation for doing a lot of M&A. We have a tremendous reporter, Sam Bajarski, who is an expert at writing about regulation. We have a reporter, Alec Rich, who's been with us for about a year, who's coming on really strongly, covering a lot of executive changes, cybersecurity, technology. We have my deputy editor, Andrew Forch, who's a tremendous profile writer and breaks plenty of deal stories in his own right. So we kind of cover the industry from like a global perspective, and then we kind of break stuff down by certain themes as opposed to breaking it down by certain companies or sub-industries.
Well, I think, all right, so you said a lot. I think you guys won. Citywire won, in my opinion. You were not the first, at least as far as I'm aware, publication covering advisors in this industry. A lot of your competitors have gone by the wayside or are struggling, but you guys, I see you send out every week the top 10 most read or most clicked or whatever articles on the site. And I never miss it. And I always shudder when we're on there. But you guys are obviously doing something right to cover this industry in a way that is resonating with your readers and the advisors that read you. So congratulations on all your success. What's your general take on the state of the RIA industry in 2025? Where do you think we are?
So first off, thank you for the compliment. I would respond by quoting the great Satchel Paige, who said, "Don't look back. Someone might be gaining on you." So we try to live, and I try to report every day from the perspective of what have you done for me lately. You're only as good as your latest scoop. So I still feel a tremendous amount of pressure to produce every single day. Now, to address your question directly on the general state of the industry, I view it as, and this is going to be an analogy, we're thinking out loud here. I view this as a industry as a fancy beach house built against building code. Maybe it's not on stilts in Florida. And the reason I say that is because, look, these businesses are tremendous if you're a business owner operator. They have very high profit margins. They have very sticky client retention rates, and they have incredibly strong free cash flow. That makes this a fantastic business. It's why you see TPG, KKR, Ares Management, all the biggest, Bain as well, Warburg Pincus, Hellman. It's why they're all clamoring to get involved in this space or are involved in this space. Now, I think the issue is that, we've been in a record bull run. Basically since I've been in high school, the market's been pretty fantastic with a couple of blips here and there. And I think that, not that my opinion is really worth anything here, that the extended bull run has made people maybe more confident in the health of this industry than perhaps they should be. And I think that when there is a market downturn, because look, I'm not cheering for something like this to happen, but it's inevitability within our lifetimes we'll have a protracted market drop. I think that that is going to cause some operational issues. So what I mean by that, I think the first thing is, look, you know this, very few firms are actually growing organically. That's one issue. And I think the second is, and this is what's not really reported on as much and what I tried to use my distressed debt background to write on, is the leverage position of some of these firms. I mean, some of these RIAs in 2021, like at the absolute peak before the Ukraine war happened and we had that market dip, they were trading at close to 11 times leverage. And I get that I get these are strong cash flow generating businesses, but when I saw 11x leverage, I was thinking about the distressed oil and gas explorers that were going bankrupt in 2015, 2016, had that leverage ratio, those kinds of leverage ratios. You think about how when we had a lot of market stress in 2020, there were several firms that had private equity backing that took out PPP. So there were a lot of other reasons why that was a rational decision, but you had to attest to certain things about the state of your business to apply for those loans. And so my concern is, do we see some of these major firms trip a debt covenant or two if there's a protracted market downturn? And what are the consequences of that? The other thing is also what happens when we see a firm try to go public? And we can obviously touch on that later.
All right, let's touch on the first one. How do you think, so I agree with what you're saying. Multiples are insane. So I hate to be the this ends badly person, because I'm not predicting like a reckoning or anything like that. Probably just lower returns. So if this were to end badly for certain people, do you think it's the investors that it ends badly for? Do you think it's the advisors that were acquired, or the up-and-coming advisors, or the investors or their clients, I should say? Who do you think this ends badly for?
So I think it really depends on the capital stack of these firms. So I think for context, if you're not familiar with covering distressed companies, a lot of times what happens is that the senior lenders, usually the first lien lenders, will take over and they cram down the other investors on the equity. So who gets hurt in that situation? I mean, let's take a hypothetical RIA where maybe they're over-levered, but they have broad-based employee ownership. Well, all those employee shares are going to get diluted or wiped out in a lender takeover. Oof. So that would be a potential consequence.
Not good.
No, not good at all.
What happened in 2022? Because we did have a 2-year bear market. Like, the wind wasn't always at our back for the last 7 years since you started. I mean, for the most part, but not always.
So I think it's interesting to note that, and we wrote about this a decent amount, is that it got a lot more expensive for these sponsor-backed firms to raise capital. And so what I point to is kind of the signs of market stress, were the transactions where several sponsor-backed RIAs, not necessarily going to name names, you can see them on our website, they took out these transactions that had a preferred equity component with a payment in kind function that would carry in the in the low to mid-teens. And that is, again, a typical strategy that distressed companies use. You can't necessarily meet your cash interest obligations. Okay, they'll pay you in more equity. And what that does is that further dilutes people. Now, thankfully, firms were able to kind of pay that down and manage it because the market recovered quickly. But stuff like the PIK functions, pref equity, that gives investors preferred returns or guaranteed returns. CI Financial did a similar thing when they couldn't get their IPO for the RIA business off the ground. Those are signs of stress.
So public markets have not been kind to RIAs, whether it's roll-ups or whoever. Like, there's been a few that have been spit out, a few that tried to go public where the bankers, I guess, told them what it was and they said, all right, no thanks. So private markets, like in a lot of other areas, a lot of other industries, have been much kinder to these companies than public markets. And what you saw, and the story made a lot of sense in 2018 when you started, when interest rates were very low and investors were looking for something other than 1.5% nominal on the 10-year. And they said, all right, where can we invest? RIAs, great business, super fragmented, highly unprofessionalized, massive opportunity for scale and roll-ups, and with cheap debt, it made a lot of sense, and it worked. It worked very well. The advisors who sold got paid a lot of money. The investors did very well for themselves, and everybody was having a good time. We're now 7 years later. Obviously, the story is changing in terms of access to capital. Cheap debt is not a thing anymore. And we are now, I don't know if we're 7 years in or 10 years in or whatever it is, but there's a lot of advisors that are now my age, 40, mid-40s, whatever the case may be. They didn't get a piece of the action, or if they did, it was just a crumb. And they're now looking around saying, what am I doing here? Like, what's in this for me? Are you seeing a lot of that as well?
So you bring up a bunch of really, really good points. So let's talk a little about the advisor sentiment, because I think that's probably relevant for the advisors that watch this on a regular basis. The representative example that I can think of is the creative planning, Goldman Sachs personal financial management, now known as United Capital acquisition. And you think about what those advisors who were at the United firm, then known as United Capital, then Goldman PFM, went through. They saw their firm get sold to Goldman in, I believe it was 2019. And, Goldman has a reputation to some advisors, some people in the financial service industry being, like the Lex Luthor of what they're trying to escape from. Then you have that firm sold again for the second time in a 5-year span. And there was a reason that a lot of advisors chose to head for the exits. Now, Peter Maluk in creative planning retained a large proportion, but there were plenty of firm advisors that chose to either affiliate with IBDs, or they would start their own RIA with assistance from a firm like Dynasty, or they tuck into existing RIAs. And I just think that, I view this industry almost as like a phoenix sometimes, not to get too deep into the analogies, but I think that there's certain advisors, you get into this space, you're inherently entrepreneurial. And I think there's an upper bound to the size of the organization that those kinds of inherently entrepreneurial advisors want to work for before they go out and go off and do their own thing. And that makes me think that advisor attrition is going to become an issue for some of these mega firms. And that could be something that could be a break on a potential IPO as well.
Yeah. We've been talking about the private equity backed mega companies, but it went everywhere. Even, I was about to say the firm, but a dude who manages $30 million is now being cold called to get a paycheck. Like, it is absolutely unbelievable. And so that has been going on for a while. And I'm talking to more advisors today than I have over the last 5 years when it was a free-for-all, who now see some of the experiences that their peers have had, who now understand that the checks come with all sorts of strings attached, and maybe there are better ways to do this, who are now considering either joining a company like us, who do not write checks, but it is a much different structure, obviously, or if they are going out on their own. I'm also hearing from advisors that did do their own thing. There was a very large push, I guess in the 2018 era, a very large push for like these lifestyle practices where these advisors were going to do their own thing. And then now, heaven forbid, they had a little bit of success and they're managing $70 million, $100 million, whatever it is. They're now at a juncture where it's like, hey, wait a minute. I got into this industry to be an advisor, and now I'm running a small business, and that's not really what I want to be doing. So I know I said a lot, but what about those advisors?
No, I mean, I think you bring up a really good point. And, that's why the dynamic that you're describing is what's driven a lot of the M&A in this industry, where these businesses have gotten too big and too valuable for the existing management structure to hold on to them. So it's tough because I feel like you look at some of these smaller platforms, I mean, like an XY planning network, I can think of Facet Wealth, another one that kind of specializes in either smaller dollar clients. I mean, there's clearly room for them. I think that the question that I have is, okay, how can you keep the operating costs if you're a smaller firm fairly slim so you can keep running at like the 40, 50, 60% margins that we see? Like, you can affiliate with an XY planning network, but I assume that some of those firms have some sort of like ongoing platform fee. So I'm not sure how much that kind of cuts into your margins. And then of course you have the 1099 contractor models as well, but those have their own strengths.
Here's another option that you guys are all over, are reporting on. These I guess, digital RIAs. I don't really know what else to call them. Savvy, Compound, Farther. Like they're taking a lot of the scraps. I don't mean that in a bad way. I know it sounds bad, but they're taking a lot of the advisors that are breaking away, that are opting out of these mega deals.
Yeah, no, I think that's definitely a viable option. I think the question that I have, now I admit that I haven't covered those three firms you mentioned as much directly myself, but the question that I would have would be, okay, obviously those are places that have some institutional backing, some VC backing, what does the equity structure look like? What's my skin in the game? Because obviously the VC investors are going to demand a return. So where do I fit in the capital stack? That's the question that I ask. And also, how are these things built to withstand some of the challenges that come with running an RIA? So you mentioned Savvy. I mean, look, Savvy has been very aggressive with recruiting, but they're also in litigation right now with Marty Bicknell and Mariner for their recruiting tactics, with Marty accusing them of poaching advisors. So, I think it's a little cliche. We think about like the move fast and break things mentality. So I would just look to make sure that those kinds of firms have have institutional knowledge and are scaling these things up responsibly without blowing through the VC money.
Yeah, those companies are raising quite a bit of money at pretty healthy, generously, I would say, valuations. All right. So getting back to your day to day, what makes a story that's worth reporting to your readers? Like, is there sometimes where you're like, it's a slow day, we'll run it, or is there a certain threshold for something to be worthy of being on the front page or with your name on it?
So that's a good question, because I think the threshold for coverage has changed as we as a business, as a publication, have matured. So I still remember, I'll go back to 2018. I still remember when, I was high-fiving my editor-in-chief, Alex, over the fact that we got an exclusive on a $100 million advisor joining Stewart Partners. That's an interesting story, but, I think what the threshold for what gets to a high five now, it's things like Goldman selling the personal financial management unit and everything going on there, the LPL Commonwealth transaction. So the threshold for what makes a great story has gotten higher. The threshold for coverage, I think, has also gotten higher as well. So I'll just use M&A as a quick example. There will probably be times even within the last couple of years where any notable acquirer, any name brand making an acquisition of any size or recruiting a team over would probably generate at least a story. But there's so much happening now, and we just have so many hours in the day and so much space to write and positions in the newsletter to fill, that the threshold has gotten higher. So it used to be maybe anything over 250 we'd write about. Now it's probably more in the range of 700 and above. And that's just because I think with the market appreciating, there's so many more firms at that AUM scale making deals. So that's kind of one filter that we would use, would be an AUM scale on an M&A transaction. Another would be on the tech side. To be honest, it's very difficult for something like an integration to move the needle. A capital raise or a new product, that's one thing, especially from a recognizable brand. But an integration in itself, that's going to be kind of a higher part of coverage. So I think in general, the two things that I would look for when deciding whether to run a story, and this applies to everything from profiles to features, is either there's an inherently newsworthy figure at the center of the story. That can be a company, that can be a person, or it's a story that's a really good example of a larger trend affecting the broader advisor community. So for example, Alec today is, just a sneak peek for the afternoon newsletter, Alec is writing a story on cybersecurity and how much or how little advisors are prepared for that. That's a good example of a trend piece.
Yeah. Getting back to your sports roots, I'm going to call you the Woj of RIA reporting. Unless, are you more of a Shams guy?
I'm indifferent between the two.
Okay. All right. So you strike me as a Woj guy, so I'll stick with that. When you have a story like Creative buying United out of Goldman, that is a big story. It's probably the story of the year in our industry. How does a story like that come to you? And you have to reveal names. I'm only kidding. But how how much pressure do you feel to, obviously you only hit publish once, you want to get the story right, but like time is of the essence there. So how does a story like that unfold?
So there's a lot of stuff to unpack there. So forgive me if we get a little bit rambly, and
Go ahead.
stop me at any point. So I think the first thing is that stories like that come from this thing right here. Like, I am working the phone, texting people constantly. And there's a network of sources. I kind of say, I call it setting up the bat signal. Let's say I get a tip like a Goldman United Capital. I will send out the bat signal and I'll text all my top M&A sources, say, hey, have you heard this? Who's banking this? And the goal is to eventually triangulate an answer and figure out the chain of custody and the provenance of that information. If you get it to 2 or 3 sources, then where it go? So that stuff is based on constantly networking, texting people, having catch-up calls. And what's good is that you eventually get to a point with certain sources where they feel comfortable texting you or calling me saying, hey, I've got something for you, and then starting the process from there. So those stories, I mean, those are based off of trust, deep relationships, a massive time investment, and that creates its own issues, which we can dive into from an ethics perspective. Getting to make sure you're not getting too close to people, covering people fairly. So stuff like that is definitely relationship based. And to your point, I mean, there is a tremendous amount of pressure. Like, I get the kind of the butterflies in the stomach feeling I'm about to hit publish on a massive story, like an LPL Commonwealth or a Goldman Creative. Like, that desire to have that feeling is what keeps me going basically every single day. Now, to specifically how I got Goldman, like the Goldman sale process, you'll find this if we can get into in the interview, is that I get stories in very strange places sometimes. And I got the Goldman selling PFM from a source texting me as I was sitting in my car for alternate side parking. So I'm sitting, working my laptop, calling people, praying that talking to Goldman's PR people, just praying for the street sweeper not to come. So it takes flexibility sometimes.
You ever thought about moving over to this side of the industry? I mean, I guess maybe like a natural place would be like on the PR side. Have you ever thought about working in the RIA industry?
So PR side, never.
Okay.
I don't have any interest in doing that pretty much at any point in my life. I would say, in terms of like what would get me to move, I mean, again, making a Giants reference, one of the reasons that Bill Parcells stepped away from coaching, this was when he was still coaching, I believe it was when he coached the Patriots, so his second retirement, was he said he hated losing more than he loved winning. And if I got to that point where I feared defeat more than I loved winning or getting a story, then it'd be time to move on. I would say that, like, I have given thought occasionally of what it would be like if I worked for one of the iBanks, or if I tried to get into an operational role. So I would say never. My preference is to stay in this business and stay as a journalist and keep getting after stuff. But the idea of working on the deal side, now that I at least have like a decent cursory knowledge of how these transactions go, yeah, I mean, I have thought about it. It'd be impossible not to, but it's not something that I would say I'm like actively looking to do. I'm very committed to Citywire and writing about this business.
Very diplomatic answer. Have you ever published a story that you had to retract or got something wrong?
So thankfully, full retraction has not happened. That's a very scary place to be in. There have been some strange scenarios. So I'll give you an example. This is without naming any company names. There's a little mini war story, and that is I published a story on a couple of executives leaving a large company in the wealth management industry. I had the names double sourced. I felt very confident in it. We hit publish. I head off on the subway to Yankee Stadium for a Yankee game, and I'm feeling pretty good. I get an email from the PR person for the company saying, just for the record, your story is incorrect. And my heart just totally stops for a second. I'm like, okay, what's wrong here? So I asked, hey, can you explain what's wrong? And they refused to. They didn't give me any further explanation. They said, this story is wrong. One of the people that you said is leaving is not leaving. So I did what you do in this scenario, which is I go back, I check my sources. One of my main sources backs up, says this person 100% gone. We move on. There's no correction. There's no retraction. 6 months later, a couple months later, I see one of the people in the story officially updates their LinkedIn post to say they've left the company. So the PR person, I believe at that time, was disputing when they were still on garden leave whether they had or hadn't left the company. One thing that you find is that in this business, you get into a lot of semantic games with PR people.
I'm sure you've had people call you more than once and yelling at you and demanding and whatever. Has anybody ever crossed the line?
I've gotten frustrated, but I think the goal is when someone's emotional to just kind of take the high road and hear them out. I also try to stay super even keeled, and I find this applies to like life in general. Is that if you're just nice and calm, and when someone's kind of going off the handle or getting frustrated, I think it kind of naturally helps disarm people and kind of take them out of that. So I try to keep this demeanor as much as possible when talking to someone who might be pissed or I might be frustrated with, and then I vent to somebody else after. So I haven't had somebody cross the line with me. I've gotten very frustrated with people before, but I make sure to not, in this, again, like saying this industry is very much a relationships-based, trust-based business. Do not ever want to say something you can't take back. That's a big fear, is permanently ending some sort of relationship over a hill not worth dying on.
How do you think advisors think about the media that covers us?
So that's a good question. It gives me a chance to give you another mini story. I think that there are some advisors who love talking to the press, who love being part of media. I mean, I think that your firm is a great example, right? Like everybody in your business is super media forward, super media savvy, knows what it is to get exposure. And I think that there are some that view it as kind of a necessary tool just to get their message out or spread publicity about the firm. I think there are some that are inherently skeptical, either maybe just an inherent lack of trust of journalists in general, or they fear kind of the loss of control, especially if the loss of control of a narrative. So here's another good example, which was, all right, a couple months or so back, I got a tip on a decently sized RIA running a sales process. That's the type of story that we see in the newsletter multiple times a week. I have the investment banker confirmed from multiple sources. I feel good to go. As a professional courtesy, I go to the CEO of the firm. And the CEO tells me, we are not for sale. This is completely BS, totally false. Is this what the iBankers do to force people to sell? So obviously I'm confident in my sourcing, but getting this level of vehement denial from the seller, I'm not going to publish over that denial. Like unless I physically had the SIM deck in my hand, I'm not going to run it over that strong of a denial. So we held on it. I filed it in my long-term news list. I do nothing. Little while later, a PR firm reaches out saying that said firm had agreed to sell a decent stake in itself. And so this CEO had just lied to me, just straight up gaslit me. And the explanation I got was that they were afraid of what would happen if that story got out. They were unfamiliar. So they were in panic mode because they didn't know what would happen if that process got out there. So, I got he was trying to protect his business, but deliberately lying to me, talked about a line you can't cross. I mean, if you deliberately lie to me, it is game over. I'll still treat you professionally and treat you fairly, but the trust gap that can never be built, you can't bridge that gap, basically. If I know someone's going to deliberately lie to me to deceive me, I have no reason to give any credibility to anything that they say.
Yep. All right, last question. Who do you think is the first firm in our industry to go public? And how do you think the public markets will treat them?
That is a very good question. You basically threw me a BP fastball right there. I think that the firm that's best positioned to go public is Creative Planning.
I would agree.
That's for a number of reasons. One is that they have a very clean ownership structure. They haven't sold any pref stakes. So you
founder-led.
have Peter Maluk, the founder, majority control. A decent chunk of employees now have equity. And then you have two sponsors, TPG and General Atlantic, with minority positions in the company. Two, they already have a print very recently at a very strong valuation and earnings multiple, which we broke at Citywire for the shameless self-promotion.
Well, was it 14? What was the number?
16 billion enterprise valuation. And depending on the math, about like a 21 to 23 times earnings multiple. That's very, 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 very strong. And that's great validation from a well-established institutional investor.
They obviously have scale. One of the only ones that do, and they're growing. They're still growing very rapidly. So 21 or whatever the 21, 23 times, go out a year or two, and it's a much, much lower number. But
what helps them as well is that, like you said, it's a wholly integrated business. There are no 1099 contractors. It's all W-2 employees with ironclad contracts. So Creative has a tremendous amount of control of both the advisor and the client relationship. Like you said, they're growing strongly both through referrals. They are a very strong player in TD's Advisor Direct program for a long time. They have a role with Schwab now. So you have strong organic growth. They do a lot of acquisitions, pretty selective at it, but when they swing pretty big, like the Goldman PFM, now United Capital deal. So you have an integrated business, strong margins, growing, clean ownership structure. And what helps is that they're arguably, and this is something that I've picked up over the years, is that they're arguably underlevered relative to the rest of the marketplace. So they have the capacity to take another couple turns on if they raise additional debt capital. So we think about public comps. I mean, the strongest public comp, and I'm going to do a little bit of live math right now, is LPL Financial.
Dangerous game.
So LPL is currently trading at like a 27.4x earnings multiple, which is really strong. Really strong, and that's in part, because I think a lot of people love LPL for the cash sweep economics, and view it as a play like that. Now, if Creative went public at 23, 24, 25, validating the TPG multiple, that could open the floodgates for other people to come out. I think the issue is, and this is why it's been so hard, is that let's take CI Financial. CI was paying, especially in the early days, 2020, 2021, they're paying really aggressive multiples to buy established RIAs because they did not have a track record. And so the issue that they had was that when they were trying to go public in the depressed IPO marketplace with the lower market based on the Ukraine war situation, if they had gone public, they would have had multiple compression. And all it would have done is just light people's money on fire. So I think if a Creative could get it out at like a 23 to 25 in that range, then a lot of these other firms that have had valuation prints in the 20x range, like a Cerity Partners, could eventually follow them. So they're the best shot. They're the flag bearer at the Olympics.
Agreed. All right. I lied. I have one more question. By the way, that was not a deceitful lie. Please trust me. That was an accidental lie. Okay. You mentioned the referral program, which I don't know if Peter pioneered it. Well, let's say that they pioneered. He was a huge beneficiary of it. I saw one of your competitors yesterday or 2 days ago publish about Schwab scrapping their plans to notify certain RIAs that they were going after accounts, personal accounts, unmanaged accounts with $1 million or more. They said, actually, we're not going to do that because, needless to say, there was a bit of backlash. There is a really interesting thing happening between the Custodians and the advisor. Is this a beat that you cover?
Yes. I mean, we broke
so talk
earlier.
about it.
Yeah, so you actually give me a good chance. I mean, the best read story that we've had all year was when we actually broke that Schwab was raising fees on the Schwab Advisor Network referral program.
And why wouldn't they?
Exactly. Well, I think that's kind of one of the other, we talk about the elephants in the room. One is that the leverage situation. The other is that Charles Schwab is basically, they're the real godfather of this industry. The single largest custodian, they hold all the cards. Because the thing is that we talk about client stickiness. Client stickiness they aren't quite as sticky when you have to repaper. Like, there's a reason that we see client attrition going from wirehouse to RIA, wire to wire, wire to IBD. So I think Schwab has the power where they can do pretty much anything that they want to. They hold all the cards.
What's the advisor going to do?
Yeah, exactly. That's the thing, is that this is why you have startup custodians. This is why you have the startup custodians. You have the Altruists of the world. You have the Betterments of the world, the Apex Clearings of the world, Robinhood making a play. Goldman has got into the custody business. If someone can find a way to make the account transfer process a little bit more palatable, then maybe we could see Schwab start to lose assets. But the bottom line is that they can do whatever they want, and the friction of repapering, I think, basically holds advisors kind of captive. Now, again, I'm not saying this is a good or bad thing. This is just the position that Schwab is. I mean, they're the biggest custodian. I mean, the custodians power so much of what we're seeing here. The referral business generates all the organic growth for a lot of RIAs who are dependent on those relationships with the Schwab branches. So, yeah, I mean, it's kind of a tough situation to be in where you have one company that holds all the cards.
Two, Fidelity as well. So I would say that two things. I think that Schwab and Fidelity will be just fine. They can do whatever they want. They will do whatever they want. But at some point, not that there's going to be like a reckoning or anything like that. Like I said, they'll be just fine. But this bodes very well for Betterment and for Altruist and for other custodians that are enabling REAs and not competing with them. So I think that is going to be a big story to watch this year, next year, the year after, and the year after that. So I know that you're going to be all over it, as you are with all things the RIA industry, the wealth management industry. Ian Wenik, thank you so much for coming on, and thank you for all the work that you do. We appreciate it.
Thank you for having me. Hope to do it again soon.